Hello students, welcome to EPG Pathshala. I am Dr. Savita from Maharaja Agrasen University, Baddi, Himachal Pradesh. Today we are going to talk on module Theory of Cost 1 from paper Managerial Economics. After completing this module, you will be able to understand the various types of cost concepts, difference between those cost elements that are relevant for managerial decision making and those elements which are not used for this purpose. You will also be able to learn the significance of opportunity costs in business decision making, nature of cost curves in short period, relation among various cost curves, and why short-run cost curves U-shaped. In managerial economics, cost is bethought from the producer's or firm's point of view. In producing a commodity or service, a firm has to employ various factors of production such as land, labor, capital, and entrepreneurship. These factors are to be rewarded by the firms for their contribution in producing that commodity. This reward is the cost. Usually it terms as factor price. Thus, the cost of production of a commodity is the aggregate of price paid for the factors of production used in producing that commodity. The term cost has different meanings. Accountant view of cost is different from that of economics. The accountant tends to focus on the explicit and historical cost. On the other hand, economists emphasize that for the efficient decision making by the firm, it is opportunity cost rather than explicit and historical cost that must be considered. Types of cost. The term cost has various concepts. These are money cost, opportunity cost, and real cost. Money cost. When a producer pays in term of money or cash in order to produce a commodity is called money cost. The payment made in cash or money to the owner of factor of production, raw material, or any other resource used in production is called money cost. This cost may be in form of payment in money for the purchase of raw material, payment of interest for the use of capital, payment of rent for the use of land or building, electricity bill, publicity, packing charges, transport and insurance premium, etc. Money cost has two constraints, that is explicit cost and implicit cost. Explicit cost. Explicit cost refers to all expenses made by a firm to purchase goods directly. It includes payments for raw material, wages, rent, interest, depreciation charges, transportation, power, high fuel, advertising, taxes, and so on. In nutshell, we can say that explicit costs are those payments which firms make to outsiders for contributing their services and goods. Implicit cost. Implicit cost may be defined as the earning of those employed resources which belongs to the owner itself. In fact, these costs refer to the implied or unnoticed costs. Implicit cost includes the rent for entrepreneur's own building or land, interest on his own capital, wages for his own labor, etc. In short, we can say that implicit costs are the cost of self-owned, self-employed resources. Opportunity cost. The concept of opportunity cost was first developed by Austrian School of Economics, but afterward it was propounded by American economist named Davenport. It is also known as transfer cost or alternative cost. In simple words, it is the comparison between the policy that was chosen and the policy that was rejected. So, cost of production of any unit of commodity for the value of factors of production used in producing other units is called opportunity cost. As the resources of the society are scarce and have alternative uses, when these resources are put to use for the production of particular type of commodity, then they are not available to produce other goods at that point of time. The production of some of the other goods have been sacrificed. For example, you have 100 rupees. You can buy pen or register with this amount. The price of both is same. If you buy pen, you have to sacrifice register, and if you buy register, you have to sacrifice pen. So the opportunity cost of pen is register and the opportunity cost of register is pen. So the opportunity cost is the next best alternative that you have to sacrifice. It is the cost of next best alternative good. Another concept of cost is the real cost. It is a philosophical concept which refers to all those efforts and sacrifices undergone by various members of the society to produce a commodity. It is also called social cost of production. In simple words, payment made to factors of production to compensate for the total sacrifice and efforts for the services they rendered is known as real cost. According to Marshall, the exertion of all the different kind of labor that are directly or indirectly involved in making it, together with the abstinence or rather the waiting required for saving the capital used in making it, all these sacrifices together will be called the real cost of production of commodity. So, the real cost of production signifies toils, troubles, sacrifices on account of loss of consumption for saving, social effects of pollution caused by factory smoke, automobiles, etc. Concepts of cost. Time plays an important role in the theory of cost. On the basis of time period, costs are divided into two parts, that is, costs in short run and cost in long run. In the short period, costs are mainly of the three types as it is seen in the diagram. These are total cost, average cost, and marginal cost. Total cost of production is the sum of all expenditure incurred in producing a given volume of output. In other words, the amount of money spent on the production of different level of a good is called total cost. Conceptually, total cost includes all the types of money costs, explicit as well as implicit. Symbolically, total cost is equal to fixed cost plus variable cost. Fixed cost, the cost which remain fixed at any level of output, is known as fixed cost. Fixed costs in short run remain fixed because the firm doesn't change its size and amount of fixed factors employed. Fixed costs or supplementary costs usually include payment of rent for building, insurance premium, depreciation and maintenance, administrative expenses, that is salaries of office and managerial staff, interest paid on capital, business taxes, license fees, etc. It is also called indirect cost, overhead cost or supplementary cost. It can be explained with the help of table and diagram. This table shows that at various quantities of output, fixed costs remain the same, that is rupees 100. Even a producer, when produces no output, fixed costs remain the same, that is 100. Fixed cost can be shown with the help of diagram also. As it is seen in this diagram, output is shown on y-axis and cost is taken on y-axis. FC is a fixed cost curve. At any level of output, fixed cost is fixed. Variable cost refers to those costs which change with the change in the volume of output. So, the cost which is incurred on variable factors of production such as raw material, wages and transport, etc. Variable cost is also known as direct cost, special cost or prime cost. In short run, variable cost includes prices of raw material, fuel and power charges, excise duty, sales tax, transport expenditure, wages of labor, etc. It can be explained with the help of following diagram and table. In table, as the output increases from 0 to 40 units, variable cost is increasing at a decreasing rate. It means when firm produces 0 units, variable cost is also 0. When firm goes on increases their production, that is to 10 units, its variable cost is 100. When firm goes on increasing the level of production, that is up to 40 units, their variable cost is 280, which shows that it is increasing at a decreasing rate. But when firm goes on increasing their production from 50 to 60 units, then variable cost increases at a constant rate. And if firm produces more output, that is from 60 to 80 units, variable cost start to increase at an increasing rate. So, it is clear from the table that if firm goes on increasing production, first variable cost increasing at decreasing rate, then it becomes constant and then it increasing at an increasing rate. Variable cost can be shown with the help of figure also. In this figure, output is measured on x-axis and variable cost is measured on y-axis. Variable cost is increasing first at decreasing rate and then constant and then increasing rate. Fixed, variable and total costs in short run. In order to determine the total cost of a firm, we aggregate fixed as well as variable cost at different level of output. So, total cost is a sum total of fixed cost and variable cost. Symbolically, TC is equal to FC plus VC. Here, TC means total cost, FC means fixed cost and VC means variable cost. It can be shown with the help of following table and figure. In table, TC is equal to TFC plus TVC. Here, TC means total cost, TFC means total fixed cost and TVC means total variable cost. Second equation is TFC is equal to TC minus TVC. Here, TFC means total fixed cost, TC means total cost and TVC means total variable cost. And the third equation is TVC is equal to TC minus TFC. It means total variable cost is equal to total cost minus total fixed cost. So, in this table, when output is 0, variable costs are also 0. But fixed cost as well as total cost are rupees 100. As the output increases to 80 units, total cost go up to 720. Total cost goes up to 720. It means as the output increases, fixed costs remain the same but variable costs increase at diminishing rate and then increasing rate. This relationship has been shown in the following figure. In figure, quantity is measured on OX axis and cost on OY axis. FC is fixed cost curve which is parallel to horizontal axis, which signifies the fact that at all level of output, fixed costs remain the same. VC is variable cost curve. It is of the shape of reverse S. It means as the output 0, variable costs are also 0. TC shows the total cost of production. It is a sum total of fixed cost and variable cost. Average cost. Per unit cost of a commodity is called as average cost. According to Dooley, the average cost of production is the total cost per unit of output. In other words, average cost of production is the total cost of production divided by the total number of units produced. For example, cost of producing 100 units is 20,000. So, the average cost will be 20,000 divided by number of units. It means 20,000 divided by 100 is equal to 200. So, another way to calculate average cost is AC is equal to AFC plus AVC, where AC means average cost, AFC means average fixed cost and AVC means average variable cost. Average fixed cost. Average fixed cost is the total fixed cost divided by the number of units of output. It is the per unit cost of fixed factors of production Thus, AFC is equal to TFC divided by Q. AFC means average fixed cost, TFC means total fixed cost, Q means quantity. Since total fixed cost is a constant quantity, average fixed cost will steadily fall as output increases, and thus the average fixed cost curves slopes downward with a view to touch the horizontal axis. But it will not be so because AFC can never be zero as it is seen in the diagram. Average fixed cost. Average fixed cost is the total fixed cost divided by the number of units of outputs. It is per unit cost of fixed factor of production. Thus, AFC is equal to TFC divided by Q. AFC is equal to average fixed cost, TFC is equal to total fixed cost, and Q is equal to quantity. Average variable cost. Average variable cost is the total variable cost divided by the number of units of output produced. Thus, ABC is equal to TVC divided by Q. ABC means average variable cost, TVC means total variable cost, and Q means output. Normally, the AVC falls as output increases from 0 to the normal capacity output due to the law of increasing returns. But afterward, the AVC will rise because of the operation of the law of diminishing returns. It is always U-shaped as it is shown in the following diagram. Relationship among average cost, average fixed cost, and average variable cost. Average cost is the sum total of both average fixed cost and average variable cost. This is shown with the help of following table and figure. This table shows that AC decreases as the volume of output increases from 1 to 7 units, and then it starts to increase when volume of output increases to 8 to 9 units. Relation among average cost, average fixed cost, and average variable cost can be shown in the following figure. It is observed from the figure that average cost is the sum total of both average fixed cost and average variable cost. Average variable cost and average fixed cost both falls with the increase in output. AVC, that is average variable cost, starts to rise with the increase in output, and AFC, that is average fixed cost, will fall continuously. AC, that is average cost, also falls up to a certain stage. With the increase in output, AVC start to increase beyond a certain point and AFC remain decreasing, but AC also start to increase, remaining minimum at some stage. AC, that is average cost curve, is U-shaped because it is a combination of average variable cost and average fixed cost. In short period, average cost curves are of U-shaped, which shows initially it falls and after reaching the minimum point, it starts rising upward. There are some points that justify the U-shaped AC curve. These are: it is due to average fixed cost and average variable cost. It is well known that average cost is the aggregate of average fixed cost and average variable cost. That is, we all know that AC is equal to AFC plus AVC. In the initial stages, as production increases, both AFC and AVC falls. When AFC and AVC added, then the falling rate of AC will be more. If production continuously increases, then AFC, that is average fixed cost, will fall, and AVC, that is average variable cost, will be minimum at one stage. At that time, AC will also be minimum. In the last stage, when the increase in production, AFC goes on falling, that it means average fixed cost goes on falling, but average variable cost starts to increase. Adding both, the increasing rate of AC will be more than AVC. If we join all three stages of AC, then we will get U-shaped AC curve. It can be seen in the following diagram. Variable proportion. The law of variable proportion states that when variable factors are combined with fixed factors in short run, then production in the initial stage will increase at an increasing rates, then constant rates, and then in last stage production will increase at diminishing rate. Due to indivisibilities of the factors of production. Another reason due to which the average cost curve forms U-shape is the indivisibilities of factors. When in the short period a firm increases its production due to indivisibilities of fixed factors, it gets various internal economies. In these economies, which cause the average cost curve to fall in the initial stage, when these fixed factors are fully utilized by the firm, then cost of production begin to rise again. So, average cost increases. It can be seen in the following diagram. When it goes down, then the firm will enjoy, as when it goes down, firm is enjoying economies of scale, and after reaching at a certain point, average cost goes on increasing. It means there are some diseconomies of scale. Marginal cost. The marginal cost is the addition made to total cost by producing one more unit of output. In other words, marginal cost may be defined as the change in total cost associated with a one unit change in output. It is also an extra unit cost or incremental cost, as it measures the amount by which total cost increases when output is expanded by 1 unit. It can also be calculated by dividing the change in total cost by the 1 unit change in output. Symbolically, marginal cost is equal to change in total cost divided by change in quantity. It can be shown with the help of following table and figure. It is clear from the table that when 1 unit is produced, then total cost is rupees 200 and total cost increases to rupees 280 when extra 1 unit produced. Marginal cost of producing 1 extra unit is rupees 80, that is 280 minus 200. It shows MC will fall initially with the increase in production, then remain constant, and then it starts to increase. In this figure, output is taken on OX axis and marginal cost on OY axis. It is observed that MC, that is marginal cost, is decreasing with the increase in the quantity of output. Then it starts increasing with the increase in the size of production. It is also U-shaped. Relationship between average cost and marginal cost. Both average and marginal cost are calculated from total cost. As it is known, average cost is the ratio of total cost to total output. In the same way, marginal cost is also calculated from the total cost. It refers to an addition made to total output by producing one more unit of output. Initially, both marginal cost and average cost curves are sloping downward. When AC curve is falling, MC curve lies below it, as can be seen in the figure. When AC is rising, after the point of intersection, MC lies above it. When AC is constant, MC becomes equal to AC, and MC cuts AC at its lowest point. Students, let's summarize what we have learnt in this module. This module has focused on the basic concepts of cost. Money cost is the money expenditure on different factors of production. Money cost includes cost of raw material, machinery and equipment, wages, salaries and supplements, rent on business premises, interest paid on capital, power, fuel, charges, insurance premium, etc. The implicit cost is the earning of those resources which belongs to owner itself. For decision making, both explicit as well as implicit costs are important. The opportunity cost is the return from the second best use of resources, which the firm foregoes when taking up the opportunity of its best use. Fixed costs don't vary with the level of output, whereas variable cost changes with the changes in the level of output. In short period, cost curves are always of U-shaped. It suggests initially falling and eventually rising. Marginal cost is the ratio of change in the total cost to a change in output.